Here's a question most retirees can't answer confidently. Have you ever made a non-deductible IRA contribution? And if so, can you prove it? If the answer is no, you could be on the hook for paying taxes twice on the same money. It's a common tracking mistake that we see, and your custodian won't be of any help if you make this mistake. So first off, if you're someone who isn't familiar with non-deductible IRA contributions, or you're not sure if you've ever made one, let's break down what exactly these are. We're going to first start by reviewing what a normal deductible contribution looks like. Most of you should be quite familiar with this process. You have money you want to contribute to your traditional IRA, say $5,000. You make this contribution, and the full $5,000 goes into that traditional IRA, and in return, you receive a deduction on your tax return, which is going to lower your taxable income by $5,000. Then, over the years, you keep that money invested, it grows to some value in the future, and great, now you're in retirement wanting to withdraw that money to live on. Here's now where you pay tax on whatever you withdraw. You originally put that money in and received a tax deduction. Now, when you take that money out, you owe that deduction back of sorts. The full amount of your withdrawal is taxable here. Okay, so simple enough. Most of you are quite familiar with this. Let's talk about a non-deductible IRA contribution. Effectively, what happens here is the entire process is flipped with some minor asterisks. Here, we take the same $5,000 contribution, but now rather than getting a deduction for this contribution, it is a non-deductible contribution. So you actually pay tax up front on this contribution. So say you're in the 22% tax bracket. Well, if you were taking an original $5,000 paying taxes on it and then making that contribution, only $3,900 would actually go into your IRA. If you were paying the tax ahead of time, you would obviously be paying 22% tax to get down to a $5,000 contribution. The point here is you're not getting a tax deduction anymore for this contribution. Now, if you make multiple contributions like this over the years, those contributions continue to accumulate inside of your traditional IRA. We'll talk about what happens on the growth of these contributions here in a second, but then down the road, when you decide to withdraw these non-deductible contributions, the good news here is you will not owe any tax because you've already paid tax when you first put that money in. So why would anyone perform non-deductible contributions? Well, there are two main reasons here. First, many high income earners perform these type of contributions because they open up a strategy called a backdoor Roth. On the left-hand side of the screen, I have the income limits for contributing to a Roth IRA. As you can see, if you end up making too much money, you aren't able to contribute to a Roth. However, there is a way around this IRS income limit, and that comes in the way of this non-deductible contribution. Say you make a $7,000 non-deductible contribution this year, as there is no income limit for this type of contribution. You already paid tax on this contribution, so you can perform a Roth conversion immediately and convert the full $7,000 into your Roth IRA, and voila, you basically made a Roth IRA contribution just through a backdoor method. Now, there's one very important and somewhat tricky rule that you need to consider here. It's called the Pro Rata Rule. And this rule determines if any of this conversion will be taxable. Here's how the Pro Rata Rule works. The IRS is going to look at all of the total IRA funds that you have, whether they are traditional IRAs, SEP IRAs, or simple IRAs. It will not count accounts like 401ks or inherited IRAs. Well, the IRS is going to aggregate all of those IRA funds together, and the amount that you convert or withdraw will be on a pro rata basis. This is easiest to explain via an example. So say throughout our various IRA accounts, we have $180,000 in pre-tax IRA funds and $20,000 in after-tax funds. We try to perform a $20,000 conversion to isolate those after-tax contributions and try to convert that to Roth tax-free. Unfortunately, this will not work due to the pro rata rule. The non-deductible contributions make up 10% of this IRA's funds, so when a Roth conversion or withdrawal is performed, 90% of that event will be taxable and only 10% will be tax-free. This is what some experts call the cream in your coffee effect. Once mixed together, it is difficult to separate out. You can't just isolate out those non-deductible contributions. So for anyone performing backdoor Roths like this, it's generally best to avoid making normal traditional IRA contributions or rolling monies over from a company plan into a traditional IRA, because now you're creating this mixing effect that is difficult to separate. Instead, keep your traditional contributions inside of your 401k and only make non-deductible contributions to your IRA so you can keep that non-deductible portion separated. It's also worth noting that the pro rata rule is assessed on December 31st of each year. So let's say you had an IRA with an after-tax contribution already isolated and you performed a backdoor Roth conversion, but then later in the year rolled a 401k over into your traditional IRA. Unfortunately, you just mixed the cream and the coffee and did so before year end. So that pre-tax rollover will subject your backdoor Roth to the pro rata rule and will force a portion of that conversion to be taxable. Now, another method that you have if that money is already mixed is the option to just continue stacking non-deductible contributions. The important thing to note here is that when you do this, growth on the non-deductible contribution will be considered pre-tax. So let's walk through a quick example to show what I mean here. Say you have a $200,000 traditional IRA with $20,000 in non-deductible contributions. This account grows 10% over the year. Now, if growth happened equally, your after-tax contributions would grow to $22,000 from that 10% growth. But remember, all growth is considered pre-tax. So what actually happens here is the non-deductible portion stays at $20,000 and your traditional portion or pre-tax portion grows to $200,000. This typically happens when someone can't readily perform a Roth conversion and just isolate that after-tax basis, but wants to continue stacking after-tax contributions. Those contributions are still non-taxable on withdrawal or conversion in relation to that pro rata rule. There's also an opportunity down the road to actually isolate that basis, even if everything's mixed right now. This is beyond the scope of this video, but there's a method called a reverse rollover that can be used here. Here's how it generally works very high level. Say a taxpayer's 401k allows you to do a reverse rollover, meaning you're rolling funds into the 401k. Well, you can only reverse rollover pre-tax values. So a taxpayer down the road could roll over their pre-tax IRA portions into their 401k and then isolate out that $20,000 of after-tax IRA funds and then perform a non-taxable Roth conversion because 401ks don't factor into the pro rata rule. So stacking non-deductible contributions does have value, even if that Roth conversion can't be performed this year. So now let's talk about where a double taxation problem can occur if you're not careful. Let's say you're a DIY investor that has watched a bunch of videos on backdoor Roths, and because of this, have been making a bunch of non-deductible IRA contributions over the years. Eventually, you might plan on converting those after-tax contributions, but let's say can't right now due to the pro rata rule. Well, logically, you might be thinking that your custodian is tracking all of these non-deductible contributions so that when you eventually withdraw or convert, the custodian will take care of all the reporting requirements to the IRS. Unfortunately, custodians don't do this. You as the taxpayer are required to keep accurate records of all of these contributions and then navigate the pro rata rule yourself. You do this through filing a form called Form 8606. You must file this form each year that you've changed the composition of your IRA. So let's say that you do a non-deductible contribution in a given year. Even if you didn't make a withdrawal or conversion, you need to file Form 8606 to tell the IRS, hey, of that $200,000 IRA that I have, $20,000 of that is after-tax contributions from this and years prior. If you don't do this, the IRS assumes that full $200,000 is pre-tax. You also need to file this form if you take a distribution or contribution in a given year. Why? Because your after-tax basis is now updated due to that pro rata rule. Say we have a mix that we've previously been discussing of $20,000 in after-tax contributions and $180,000 in pre-tax contributions. You withdraw $20,000. 90% of that will be taxable, 10% of that will be withdrawing that after-tax basis. So you need to file Form 8606 and update your basis from $20,000 to $18,000 due to this withdrawal. Now, if you've had a year where you didn't make any contributions, any conversions, or any withdrawals, this is technically a year you don't need to file an updated Form 8606 because nothing has technically changed. Your after-tax basis will not change unless you make a contribution, conversion, or distribution because all growth will be considered pre-tax and not change the after-tax composition. The final thing you need to know here is you only need to file this form for your IRA accounts. If you're someone who has been making some big after-tax contributions to your 401k account in order to increase the total contribution limit you have to your company-sponsored plan, you don't have to do any reporting requirements related to your 401k. The 401k provider handles all of that for you. This form is just for IRAs. But here's a problem we've seen retirees run into if they aren't filing Form 8606. Let's say we have an account that looks like this: $400,000 in pre-tax IRAs, $50,000 in after-tax contributions, and then we have another $60,000 in after-tax rollovers that we previously had in their 401k. we perform a $100,000 conversion or take a $100,000 withdrawal. If we haven't been filing Form 8606, well, you can simply just throw the pro rata rule out the window because 100% of this withdrawal or conversion will be taxable. The IRS has no idea you have any after-tax contributions because you haven't told them so. So even though you've already paid tax on $110,000 in this account, which is 21.5% of this account, the IRS doesn't know this. So that $110,000 of after-tax amounts will be taxable a second time when you eventually withdraw or convert that money. Now, this is a massive issue that leads to you eventually being taxed twice. Now, some of you may be watching this video and immediately feel a bit of panic arising. Maybe you're someone who has made non-deductible contributions like we've described, but have never filed Form 8606. Well, here's the good news. The IRS makes this mistake relatively easy to remedy. You can retroactively go back and file previous year's forms as long as you have good records of amounts and when you made these contributions. So you can go back and file forms for 2020, 2021, 2022, and so on quite easily. You just need to make sure you have good records and the right amounts for each given year. If you've been a DIY investor and have made this mistake up to this point, it might be easiest to hire a CPA that is familiar with this process, at least for a year, to help update your situation and get you back on track. Non-deductible contributions can be a great hack and can lead to some pretty powerful strategies like backdoor Roths, but you need to know the rules and filing requirements so you can do it correctly and avoid double taxation. Now, if you found today's video helpful and want to go deeper into other lesser known IRA rules, I've got one that can actually save you thousands when doing a Roth conversion. Click here to learn more about a powerful IRA hack that most investors and even some advisors completely overlook. It might give you a get out of jail free card when you need it most at the end of a year when you're paying Roth conversion taxes. Thanks for watching, and always remember, you don't need more money, you need a better plan. I look forward to seeing you in the next video.